Starting an LLC is exciting, but when tax season hits, things can get confusing fast. What exactly do you owe? How are you taxed? And most importantly, how can you pay less? In this video, I'll walk you through how LLC taxes work, the common pitfalls, including the hidden cost, and real examples that can help you save thousands. First of all, if you're just starting out, you might wonder, why not stay a sole proprietor? The key difference is protection. Sole proprietorships offer no legal separation between you and your business. If something goes wrong, your personal assets are at risk. An LLC gives you legal protection while still keeping tax simple, especially for single member LLCs. A single member LLC is taxed like a sole proprietorship. That means all profits pass through to your personal tax return. So, while an LLC offers legal protection, it doesn't automatically save you money on taxes. If your LLC has more than one owner, it's taxed as a partnership by default. The LLC itself doesn't pay federal income taxes. Instead, it files a partnership tax return, Form 1065. Each owner gets a Schedule K-1 showing their share of the profit or loss. Let's say your LLC made $100,000 in profit. If you're a 50-50 partner, each of you gets $50,000 reported on your personal taxes. What if you and your spouse co-own an LLC? In community property states, like California, Texas, or Arizona, the IRS lets you treat your LLC as a single-member LLC. You can report everything on one Schedule C. Simple and clean. But if you live in a non-community property state, the IRS sees you as two separate members. That means you're considered a multi-member LLC by default, and you have to file as a partnership. And just a heads up, the qualified joint venture option only applies if you haven't formed an LLC. Next topic I want to talk about is the hidden cost in LLCs. Many forget about the 15.3% self-employment tax, which covers Social Security and Medicare. Unlike employees, you pay both halves yourself. On $100,000 profit, that's $15,300 before any income tax. So planning around this is key, especially if you're growing and might switch to an S Corp. Now, how do you pay yourself from an LLC? If you're a single member LLC, you don't pay yourself a salary. You take an owner's draw, which isn't taxed when withdrawn, but your profits are taxed. With an S Corp, though, you're required to pay yourself a reasonable salary through payroll and can take additional income as distributions. Then, when do LLCs pay taxes? LLCs don't just pay taxes once a year. If you expect to owe $1,000 or more, you're required to make quarterly estimated tax payments. The deadlines are April 15th, June 15th, September 15th, and January 15th. Yes, even before the prior year's taxes are due. Missing those deadlines can result in penalties and interest. You can use IRS Form 1040-ES, which I linked in the description below, to calculate and send those payments. A good rule of thumb? Set aside 25 to 30% of your profits for taxes. That way, you're not surprised later. What if my LLC has no revenue or a loss? Even if your LLC has no income or ends the year with a loss, you still file taxes. And here's the good part. You may be able to use that business loss to offset other personal income. For example, if you made $70,000 from a W-2 job and had a $12,000 LLC loss, your taxable income could drop to $58,000. That's real savings. However, there are several important thresholds and limitations based on your business structure and IRS rules, which are summarized in the table. I'll have the table linked in the description below. Let's quickly take a look at how different business structures handle the $12,000 loss. Under sole prop or single member LLC, full $12,000 offsets personal income. Under multi-member LLC, your share, say 50%, offsets your income. Under S Corp, loss only offsets income up to your basis. If you only invested $5,000, that's all you can deduct now. The rest carries forward. Okay, now the most popular topic, how do you lower your tax bill? It's simple as use your deductions and don't miss out on any. Common LLC deductions include home office, business mileage, internet and phone, software subscriptions, and marketing and professional services. If you are a small business owner who's just starting out and working from home, make sure you include all these expenses like your network bill, your mobile plan bill, your meal expenses during business hours, and so on. When your income is low, Deducting all these bills do matter, but be careful. There are some common write off mistakes, such as trying to deduct personal meals or clothing, writing off your entire home rent without a dedicated workspace, and overstating vehicle use without mileage logs. Now, let's run some numbers to show you the importance of deduction. If you have profit of $90,000, self-employment tax will be $13,770, which is 15.3% of $90,000. Income tax will be around $13,500 using the estimated 15% tax rate. Total tax comes up around $27,270 with a 30% effective rate. Now add $20,000 in deductions for the items discussed shortly before, then taxable income drops to $70,000 and tax drops to around $21,000 by $6,000. That's real money saved. Just remember, IRS loves documentation, so keep clear records. If it's not ordinary and necessary for your business, it probably won't qualify. Okay then, does an LLC save you money on taxes? Not by default. You'll still owe income tax and self-employment tax, which is the hidden cost of LLC. But when paired with great deductions, estimated payments, or S Corp election, an LLC can become a smart money-saving tool. Then, can you save more by becoming an S Corp in general? Well, generally, electing S Corp becomes tax efficient once your profit hits around $50,000. You pay yourself a salary, and remaining profit is a distribution, not subject to self-employment tax. But S Corp come with more paperwork, payroll requirements, and IRS rules. So don't jump in blindly and do your math. When used correctly in the right timing, this simple switch can save thousands. To summarize, here's what we covered. LLCs are taxed on profit, not revenue. Hidden cost is the self-employment tax of 15.3%. Pay quarterly if you expect to owe more than $1,000. Losses may reduce other income. S Corp may save more once profitable. Owning an LLC is not set it and forget it situation. To stay in good standing, file annual reports, keep business and personal accounts separate, track income and expenses properly. Neglecting these could risk your liability protection or bring IRS problems, while your LLC can be your smartest asset with the right tax strategy. If this helped you, hit that like button and subscribe for more videos like this. Don't forget to grab your free resources in the description below. Thanks for watching.